Rustin Edwards, who's the head of fuel oil procurement at Euronav. Your thoughts, Rustin? It seems that the outcome of the sanctions and so forth is putting some stress on the shipping sector. We see that the dark fleet from Russia supposedly, being stretched, as the word might say, making massive long journeys now with products going to Asia as well as crude before it. And now we're seeing some ships being refused entry to European ports or indeed being held. Your thoughts on the impact so far on the sanctions and its sort of penetration into the tanker market?
Well, I mean, the sanctions themselves have been, I'm going to say bullish for the tanker market in general, just because of the longer ton miles, as you just mentioned. I mean, product has to go further afield now, away from the standard market location of the EU, where Russia was putting the majority of their oil product and a lot of their oil waterborne exports to other markets to A, abide by the EU embargo, and B, to find a place where they can land the product, blend it, and turn it into something else to get out of the price cap. Much to this 500,000 barrel a day cut that Russia has announced for the month of March, that can be attributed to probably to more refinery run cuts than anything else. And it looks like crude exports, at least for the time being, have not been impacted because the products is where they have the problem from what at least I can see from the makeup of what makes up the dark fleet. They have a very large set of dirty product tankers that can carry fuel oil and crude oil, but the clean product tankers is a smaller subset, and that's a fairly large volume that they have to handle. And to find places to go with it is tough to go. They have found markets for their gas oil into Africa, into Asia in some markets as well, which has then displaced gas oil that would normally be exported from Europe into Africa, back into the European market, which is coupled with the demand loss that's going on in the EU and the United States. We do see product stocks have been building for the last 9 weeks now, both in the United States and the EU, I think overall, with crude stocks building in the East. So, from a well-supplied market, tankers are becoming a bit more delayed when they start getting into the eastern discharge ports. And so that's just going to add to the ton mile argument and put more strain on the exports.
Rustin, I wanted to get your views on there was some commentary here earlier in the month by Mike Muller indicating the possibility that with all of these new sanctions and uncertainties around the legal definitions of all of this stuff, that the lawyers would be taking some time to pour through the paperwork. And so we could see a lot of oil and oil products in particular, given they were the new kid on the block in terms of sanctions, ending up in a lot of floating storage as ships have to take their time on slow sail before the lawyers could sign off on going into ports. Are we seeing any signs of that emerging?
Well, again, we're seeing supportive tanker markets due to longer ton miles. What makes a longer ton mile? A longer voyage, or ships being bottlenecked in a port, causing longer time for the voyage to come to an end. So, I mean, there have been signals of that. I mean, I think when you start adding the product flow into the equation, I mean, when I think of the Russian production cut, which seems that the point of discussion today is that's 500,000 barrels of cuts, that equals basically a couple of refineries being shut in because they can't find homes for the products that those refineries make. They can max out their crude exports, but the bottleneck they're always going to have is going to be on the light end products, naphthas in general, because there's no natural home for the naphtha that they produced other than the EU. And so it will result in some type of production cut because refineries will shut down and they can't export infinite crude, so they have to shut in the crude to match the refinery output that comes offline. But nevertheless, when we start looking at the legalities of the way that the sanctions and the price cap has been written, everything has to land into a tank and have a sale in order for it to become unprice capped. Now, to change that price cap definition as well, it has to change its customs code. So there's that legality of how do you change a custom code from product A to product B so you can re-export it. Well, that usually happens through transformation, i.e. through a refinery. So crude goes into a refinery, gets turned into other products, and then those products can be exported all over the world outside the price cap. With finished products, you have to blend, or you have to run it through a different processing unit. So if you take, for instance, naphtha that's price capped and you put it into a bunch of crude oil, well, that naphtha is no longer naphtha, it's now crude oil. And that crude oil can be exported back to the market at whatever the market value of that crude oil is. So, there are a lot of legalities that have to be looked at and examined to see how you can make the oil flow and how you can keep trade moving without having too many bottlenecks at the end of the day.
Just to quickly follow up on that, Rustin, we had in the past sort of had quick check-ins about congestion at ports, supply chain disruptions, all of that. One of the expectations with China reopening was that it would clear up these supply chain disruptions that were a big participating factor into elevated inflation around the world. Are we seeing that happen? Are the China ports easing and getting back to business as usual?
Demand for container freight is pretty poor right now. $900 for a container to move from Shanghai to Europe. That's pretty poor earnings for the container markets, where a year ago they were at 22,000.
That sounds nearly below cost. I don't know, is it? But
it is cheap. So the bottleneck that's starting to build up is now, what do you do with all these boxes that have gone to some disport and they're just sitting there and they're building up in warehouse space? Same problem that you're seeing in the United States is that because goods have come in and demand for consumer goods is not robust, both in Europe and the United States, coming from China, you see warehouse space starting to go at premium. So that warehouse space where the boxes come in and they sit and wait for somebody to pick them up from distribution hubs is starting to increase in price. And so that is going to translate back into consumer goods. So I actually think we're probably in a position to see a secondary ramp up in inflation, because that handling cost is going to start increasing. And until China's factories actually come back and actually start producing things, which actually increases demand for freight, especially on the dry bulk container side, which is currently lackluster. I mean, I'm not a buyer of the Chinese recovery story saving the world.
I wanted to get your thoughts, Rustin, just wrapping up on where I'm just reading some reports that given the sort of current situation, that tankers that may be due for retiring, and with the new sort of carbon demands coming into shipping, we had IMO 2020, and now we've got new targets coming. Will we see the retirement of tankers, or will we see that delayed, do you think?
Well, it's been delayed. I mean, if you look at tanker rates, how they were 2 years ago, when they fell off of the highs from 2020 to 2021 and 2022, you would have thought you'd see a spat of scrapping, and that scrapping hasn't happened. And it didn't happen. It doesn't look like it's going to happen, because now you have two markets. You have market A, which is abiding by all the international rules of trade and the new CII regulations, EEXI, and now we have the EU ETS coming in. And then you have the quote unquote dark fleet, which may or may not comply with all these rules and regulations and could become older and older and older as those ships find work. So because you have these two channels of trade now, that adds extra life to probably tankers going into a 25, 30-year lifespan, which then puts, of course, the world at risk of some type of major catastrophe with an oil spill, collision, what have you. The new rules are going to realign the fleet. Some vessel owners are doing fleet rejuvenations when they can find yard space, because with all these transitions, the types of ships that are being built in the shipyards are more modern, more fuel efficient, with more bells and whistles around how to reduce emissions. And on top of that, we're seeing a lot more variety of ships being constructed, i.e. more gas carriers, because a lot of the new fuels are going to require a different type of tonnage than the current tonnage we have today, especially when you start thinking if the world transitions from petroleum into an ammonia-based fuel. Well, that's a much different type of vessel than an oil tanker. We are seeing this transition happen within the industry, not only in tankers, but in dry bulk and in containers. And it's probably going to continue on for the next 5-10 years as we start getting into new technologies.